I've built my Bus 12 and Bus 13 portfolios. Bus 12 is those companies who are going to deliver the artificial intelligence to us. Bus 13 is more developed because these are the people who are right now restructuring, remodeling, revamping the internet and the data centers with new computers, and you've heard all about that. So I've got 21 stocks in the Bus 13 portfolio, and I've shown you this chart here. And as you can see, what I've done is gone back to 1999 and tracked the performance of each of the stocks, at least for those who go back that far. And as you can see, Apple has delivered over those 24 years an average annual return of 45%, Nvidia 60%, Google 22.15%. And you can see that. So my question was, what if I could eliminate those yellow boxes? And that is to say, those yellow boxes represent the years that these stocks lost money. What difference would that make in the overall performance if I could eliminate those boxes, the yellow boxes, the years of losses? And what I realized is, yeah, okay, what if, but how am I going to do that? And I got to thinking, with all the data that's available, and I'm learning how to key this data, I think I can do it. And I've come up with an algorithm or a method, and I want to share it with you. And I want to share with you what the difference would be if we eliminate those yellow boxes. And then I want to share with you how I think we can do it. That's all part of the program that I've put together on our website. Yeah, this used to be just on our Discord, which was a little complicated to use. But as of yesterday, it is up. It's at bestofusinvestors.com. All these portfolios are available. All the work that I've done to construct them is there, and it'll walk you through exactly why I believe these, well, I don't believe they are. This portfolio year to date has returned 89%, whereas the S&P has returned 18%. So the question then becomes, will they continue to give that kind of return, which I believe they will? Then how do we take out the years that give us losses? We'll get right to that right after I say that this is not financial advice.
Best of Us Investors presents Carrie Griegmeyer.
Okay, what I did was on the website, and I'll take you to the website and show you where and how you can find what I'm doing. I created this chart, and then I duplicated it on several stocks and said, okay, if I take the losses out of Apple and Nvidia, and Apple's return over the 24 years was 45.26, and Nvidia's was 60.73. If I had identified those years that they were going to lose money and went to cash, what would the results be? So let's take a look. Okay, so this is bestofusinvestors.com. As I say, it just went live last night, and kudos to Trent, my son. He oversaw this. He was responsible for getting it done. And as you can see here, you come, I welcome you. You then decide that you want to be a member, and if you want access to everything that I'm about to show you, you need to sign up for the Premium Plus. But then when you get in, you will go to Services, and you'll go to Bus 13. And here is that chart I told you about that breaks down the past history of the 21 stocks in the portfolio. Then what I said was, okay, I'm going to take a look at what happens if I eliminate the losses on Apple and Nvidia. And you'll see this little tab up here. It says eliminate the losses. And what I've done here is then I've copied and pasted Apple's performance. And then over here, I then went to zero, went to cash on Apple on the years where they lost money. I did the same thing with Nvidia. And so you can see Apple's annualized returns went from 45% to 53%. Now, that doesn't sound like a lot, but over 23 years, it makes a tremendous difference that you made, what would that be, 8 additional percent. If we did it on NVIDIA, it went from 60% to 71%. That's an 11% increase in return. So I have yet to do it for all of the whole portfolio, but you can see that if you can just eliminate the losses, just take the years, again, 71%. And that's not real important when you're in the second year invested. But then down here, where you're in the 10th year or the 9th year, and you lose 57% of your portfolio, that's a big number. And then down here, 26%. So what we want to do, in NVIDIA, look at that. You've built all this over the years. Okay, you lost 83, 70, but your $1,000 investment per month is turned into 100,000, and you lose 50% of it. So by taking that out of the equation, you accumulate massive wealth. And I want to show you now how you take it out of the equation. Okay, this is my trading views chart on Apple. There you see, and it goes back to 2012. And what I'm saying is, what if we could eliminate that period from roughly 2012, latter part of 2012 through the first part of 2014? What if we could eliminate that, and then get the signal to come back in? What I've put in here, that's the 200-day moving average. So what if whenever Apple dropped under the 200-day moving average, we got an alert, and it said sell. And then when it moved above the 200-day moving average, we got an alert, and it said buy. And we move all the way across here, and then we come into 2015, and it says sell. And we miss all this downside, and then it says in 2016 buy. And we get all this upside. We get the 2018, as we move through the subprime crisis. It tells us to get out in November, tells us to get back in April, to get back out in May, to get back in June. And then we write it up. We get out and back in a little in March in 20. And then all of this comes to our bottom line. And then we come up here, and in April of 2022, we get out, and we miss all of that. And we get back in, we take that in, and then in September, we get out. And we stay out until February of 2023, and we write it up. Is that easy? We just eliminated all the lost years. Let's look at another one. This is Amazon. Again, going back to 2013. Here we are in, it goes under the 200-day in March of 14, bounces around under it, doesn't really go above it until January of 15, and we ride it up. We get out for a short period in February of 16, and then we ride that thing all the way until November of 2018. We get out, and we get back in on April of 19. We get out probably around here in July of 19, and pretty much stay out until April of 20, and we ride all that up. And here we're bouncing in and out, in and out, in and out. We're out for the coronavirus. We get back in for a short period, and then we're out all the way through 2022, pretty much out until we get to May of 23, and now we're back in. And we're making money. We've eliminated all this losses. This is NVIDIA. Again, writing this, and then in October of 18, we're out. We don't get back in until August of 19. We're out for maybe a week in March of 20, and then we ride this sucker all the way up here until we get out probably in January of 22. Ride it up a little, get out again in April of 22, and we miss all of this. Bounce in, bounce out, get back in, and then in January of 23, we're fully invested. And we've missed all those yellow boxes. So what do? Well, as part of our program, we set up alerts and we let you know when it's dropped under the 200-day moving average and you get back in. Now, let's look at something here. How do we know when to buy? You're not in NVIDIA. You're like Kathy Woods. You got out, okay? And you've missed all this. So when do you get back in? Well, what I've put here is the Bollinger Bands. And I think we can see this is the main center of the Bollinger Bands. And we see that as long as it stays above that, it's on an upward trend. We can see right now, NVIDIA has dropped below that orange line. So I'm looking at it and saying, I want to see what direction it goes. Does it drop, close entirely? Do we get a full candlestick below that yellow line? If we do, there's a good chance it's going to come down. And then we watch to see how close it gets to this gray line. And that's where we buy. Okay? This is where we sell. If it gets down below that 200-day moving average, that's where we sell. So that's what we're putting together on Best of Us Investors. We're long-term investors, but we're smart enough to say, tell me when to get out and when to get back in. Okay, does that make sense? It makes sense to me. We know the stocks that are going to perform because we understand the change that is happening as a result of artificial intelligence and the need to build up the internet, the data centers, so that they can handle the increased load that there is going to be put upon them as a result of ChatGPT and all the other artificial intelligence and machine learning consequences that are going to put into the internet. We know the stocks. Now all we have to do is put ourselves in a position where the market conditions, where panic for unrealistic reasons brings our stock down. So we have a system to buy, and that is buy on the change, buy on artificial intelligence, buy the ones that are building the internet, buy the ones who are going to deliver the internet, and we build a system, much as we build a system to buy, built around increasing revenues. We build a system through use of technology to tell us when to get out and then when to get back in. And what we do is we eliminate those yellow boxes. And that will save us from losing 50% of our portfolio in 1 year because we didn't know when to get out. That's been solved. That's what we do at Best of Us Investors. We're a tribe of people that come together and say, hey, let's work together as opposed to working individually. Let's share your information. Every morning, my email box is flooded with people saying, take a look at this. Homer just sent me something in South Korea that I've got to look into, LP99 or something like that. Some new substance that is going to change the world. I don't know if it's for real or if it is or it isn't, but I didn't have to fight it on my own. Brian sends me stuff constantly. So does Big Bill. So this is how we work at Best of Us Investors. You just got a glimpse of how it is presented on our website. And let me ask you this. $20 a month, multiply that times 12, that's $240 a year. And you can be told why you should invest in these stocks, what their past history is, what the probability of them to continue to go up, and then get alerts as to when to get in and when to get out. Do you get that anywhere else? Is it worth $240 as opposed to in your hedge fund where you pay 2% of all your assets under management and then they keep 20% of any profits that you make? They don't share in the losses, however. So I don't know. I think that it is magnificent that the trading, the stock, Wall Street is becoming leveled. And I'm happy to say I'm a part, I believe, of leveling that. Come join our tribe. No, don't join. Get on the bus.